Hello, everybody. The topic of this section is earnings and investment opportunities. A second approach to discounted cash flow valuation focuses on future earnings and investment opportunities. Focusing on earnings and investment opportunities rather than dividends helps to concentrate the analyst's attention on the core business determinants of value. In this section, we will estimate a firm's value and calculate the growth rate of dividends based on earnings and investment opportunities. Considering the earning and investment opportunities, how to evaluate the stock value? Assuming that no new shares of stock are issued. The relation between earnings and dividends in any period is dividends T is equal to earnings T minus the net new investment T. Note that the issuance of new shares complicates the analysis but does not change the basic result. From this equation, we can get a formula for the value of the stock as follows. In this equation, ET is earnings in year T and IT is net investment in year T. There are 2 points recognized from this equation. The first one is the value of a firm is not equal to the present value of its expected future earnings. Instead, the firm's value equals the present value of expected future earnings less the present value of the earnings reinvested in the firm. The second one is that computing the value of the firm as the present value of expected future earnings may either overstate or understate the correct market value, because net new investment can be either negative or positive. In different industries, the net investments are different. In a declining industry, one might expect to find that gross investment may not be as large as required for full replacement of current capital, which means that the net investment is negative and hence capacity would decline over time. In a stable or stagnant industry, gross investment typically just matches replacement requirements. This means that the net investment is zero, and the capacity remains about constant over time. In an expanding industry, growth investment would probably exceed replacement requirements. Here, the net investment is positive and the capacity increases over time. A useful way to estimate a firm's value based on earnings and investment opportunities is to partition the firm's value into 2 parts. One is the present value of the current level of earnings projected into the future as a perpetuity, and another one is the net present value of any future investment opportunities, that is, new earnings generated less the new investments necessary to generate them. We can express this as the firm's value P0 is equal to the current earnings E1 over the market capitalization rate K plus the NPV of the future investments. For example, consider a firm called No Growth Corporation, whose earnings per share are $15. The firm invests an amount each year that is just sufficient to replace the production capacity that is wearing out. So its net investment each year is zero. Therefore, it pays all of its earnings out as dividends and there is no growth. Assuming that the capitalization rate is 15% per year, since APV of future investment is zero, the stock price would be $15 over 15% and is $100. If the NPV of future investments is not zero, how to estimate the firm's value? This means there is growth in dividends. It's necessary to calculate the growth rate first. By definition, the expected growth rate of earnings is equal to the change in earnings divided by current earnings. G is equal to delta E over E. By multiplying both numerator and the denominator by net investment I. The next equation follows. Note that the term I over E is the earnings retention rate and can be denoted as R. The term delta E over I is the rate of return on new investments and can be denoted as RI. So the formula for the growth rate of dividends and earnings per share is G is equal to earnings retention rate multiply the rate of return on new investments. That is, G is R multiply RI. Next, an example is given to explain the estimation of stock price and NPV of future investments. An analyst uses the constant growth discounted dividend model to evaluate QRS stock. She assumes expected earnings of $10 per share, an earnings retention rate of 75%, an expected rate of return on future investments of 18% per year, and a market capitalization rate of 15% per year. The first question is, what is her estimate of QRS price? The expected earnings are $10 per share and the earnings retention rate is 75%. So the dividend D1 is equal to $10 multiply 1 minus 75% and is $2.5. By the former formula of the growth rate G is equal to R multiply RI and is 75% multiply 18%, which is 13.5%. By the constant growth discounted dividend model, the price P0 is equal to dividend D1 divided by the market capitalization rate K minus the growth rate G. So P0 is obtained as $166.67. The next question is, what is the implied net present value of future investments? Apply the formula of a firm's value based on earnings and investment opportunities. P0 is equal to the current earnings E1 over the market capitalization rate K plus the NPV of the future investments. E1 is $10, K is 15%. P0 have been obtained as $166.67 in the first question. Solving this equation, the NPV of the future investments is calculated as $100. The third question is, if the expected rate of return on future investments is 15% per year, what is the estimate QRS price? The dividend D1 is the same with the one in the first question, $2.5. The growth rate changes to 11.25% because of the decreasing of the rate of return on future investments. The estimated stock price is obtained as $66.67, which is equal to 10 over 15%. This means the NPV of future investments is 0. These two questions suggest that the reason that stock price per share becomes higher is not growth per share, but the fact that its reinvested earnings yield a rate of return in excess of the market capitalization rate. That is 18% per year versus 15% per year. In conclusion, growth per share does not add value. What adds value is the opportunity to invest in projects that can earn rates of return in excess of the required rate K. When a firm's future investment opportunities yield a rate of return equal to K, the stock's value can be estimated using the formula P0 is equal to the current earnings E1 over the market capitalization rate K. In summary, in this section, we have studied the valuation of a firm's value in terms of earnings and investment opportunities, discussed the calculation of growth rate based on earnings, retention rate, and rate of return on new investments, and found that what adds a firm's value is the opportunity to invest in projects that can earn rates of return in excess of the market capitalization rate. That's all about this section. Bye.